Imagine a snow-covered mountain landscape with a pristine white layer of snow spread across the slopes. At the top of the mountain, there's a snowball, small at first, perched on the edge. As it starts to roll down the slope, it picks up more and more snow along the way, growing larger and faster as it gains momentum. With each rotation and revolution, the snowball becomes larger and larger and larger. Now, what if Goldie applies the growing snowball effect to her financial strategy? A dividend snowball, much like the snowball rolling down the mountain, represents the accumulation and growth of wealth over time through the power of compounding dividends. It draws inspiration from the concept of a snowball rolling down a hill, gradually accumulating more snow as it gains momentum. Similarly, in the world of investing, the dividend snowball focuses on reinvesting dividends received from stocks into additional shares of the same company or other dividend-paying stocks, allowing the investment to grow exponentially over time. In this video, Goldie will explore how she can apply 3 different dividend snowball strategies to accumulate wealth with her initial $50,000 investment. However, you don't need $50,000 to get started with these strategies. You can start with a few hundred or a few $1,000s and keep adding to your investment each month or year. Make sure to stay until the end, because we'll show you how to construct the ideal dividend portfolio and leverage the dividend snowball strategy. At its core, the dividend snowball strategy rests on 2 key principles: dividend yield and compounding. Dividend yield represents the annual dividend income generated by an investment as a percentage of the investment's current market price. Companies that offer dividends usually distribute a portion of their profits to shareholders as dividends. As an investor, the higher the dividend yield, the more income you receive relative to your investment. Compounding, on the other hand, is the process by which both the initial investment and any accumulated earnings generate additional earnings over time. When dividends are reinvested, they purchase more shares of the same stock, leading to an increase in future dividend payments. As these new shares also generate dividends, the cycle continues, gradually building up the investment's value. Over extended periods, the compounding effect can result in substantial growth of the investment. To illustrate the dividend snowball strategy, consider an example. Imagine Goldie purchases $10,000 worth of a dividend-paying stock with a 4% dividend yield. In the first year, she would receive $400 in dividends. Instead of pocketing these dividends, she'd reinvest them to purchase more shares of the same stock. If the stock's price remains steady, she will now own more shares, resulting in higher dividend payments in the subsequent year. This cycle continues, with the dividends and the number of shares growing each year. Over time, the snowball effect becomes evident. Initially, the growth might seem slow, but as the years go by, the compounding effect accelerates. As the investment portfolio grows larger, the annual dividend payments become more substantial, enabling the investor to reinvest even more dividends. This creates a self-sustaining cycle of growth, where the investment generates income, which is then reinvested to generate even more income. However, it's important to note that the dividend snowball strategy requires patience and a long-term perspective. The true power of compounding becomes apparent over extended periods, often spanning decades. Additionally, not all stocks are suitable for this strategy. Investors should carefully select companies with a history of consistent dividend payments and financial stability. Now, Goldie wants to explore 3 distinct blueprints for harnessing the dividend snowball model over the next 25 years. From laser-focused dividend growth to the art of portfolio diversification and the seamless embrace of ETFs, each strategy presents a unique avenue toward building a robust financial foundation. By embracing these strategies with unwavering patience, discipline, and a visionary outlook, investors can unlock the doors to a prosperous future, enriched with passive income and enduring security. The first one is the focused dividend growth strategy. In this strategy, you focus on investing in a relatively small number of high-quality dividend-paying stocks with a strong history of increasing dividends over time. The goal is to benefit from both dividend income and capital appreciation. Here's how you could implement this strategy. Identify a handful of companies from various sectors that have a track record of consistently increasing their dividends. Look for companies with strong financials and competitive advantages. Then, reinvest all dividends received into the same stocks to acquire more shares. This approach maximizes the compounding effect. You will need to periodically review the performance of the selected stocks and their dividend growth. Make adjustments if any company's financials or outlook deteriorate. Over 25 years, the compounding effect can lead to significant growth in both the value of your portfolio and the dividend income it generates. Embarking on the journey of the focused dividend growth strategy requires a keen eye for companies with a history of consistent dividend growth and financial stability. AbbVie has demonstrated a commitment to renewing its shareholders through dividends. The company's strong presence in the pharmaceutical sector and its portfolio of market-leading drugs have contributed to a stable revenue stream. Imagine Goldie acquired 833 shares of AbbVie at $60 per share for a total investment of $50,000. At the time of purchase, AbbVie had an annual dividend yield of 4%. This resulted in an initial annual dividend income of $2,300. Instead of pocketing the dividends, she reinvests them back into AbbVie by purchasing additional shares at the prevailing market price. As AbbVie's dividends continue to grow over time, so does the number of shares acquired through reinvestment. Over the course of 25 years, AbbVie's strong performance in the pharmaceutical market leads to both capital appreciation and dividend growth. As the investor consistently reinvests dividends, the compounding effect takes hold. A growing number of shares leads to higher dividend payments, which are reinvested to acquire even more shares. At the end of 25 years, Goldie's portfolio has not only witnessed the appreciation of AbbVie's stock price, but has also accumulated a substantial number of shares through dividend reinvestment. Her original $50,000 investment could grow to an estimated market value of approximately $350,000. The second option is creating a diversified dividend portfolio. This strategy involves creating a diversified portfolio of dividend-paying stocks across various sectors and industries. The goal is to minimize risk while still benefiting from the power of compounding dividends. To implement this specific dividend snowball strategy, Goldie would need to buy a diversified portfolio by selecting dividend-paying stocks from different sectors, such as technology, healthcare, consumer goods, and utilities. This diversification helps spread risk. She would need to reinvest dividends across the entire portfolio, allocating them proportionally to each stock based on its market value. Whether it's you or Goldie, it will be important to regularly rebalance the portfolio to maintain the desired allocation. As certain stocks grow faster, they might become a larger portion of the portfolio, increasing risk. Over time, this strategy aims to capture growth opportunities across multiple sectors while benefiting from compounding dividend income. Diversifying a dividend portfolio involves selecting a variety of dividend-paying stocks across different sectors to spread risk and capture growth opportunities. So let's explore how Goldie creates and manages a diversified dividend portfolio over a 25-year period. Goldie starts by researching and selecting dividend-paying stocks from various industries. She chooses companies with strong fundamentals and a history of stable dividends. Her portfolio includes stocks from sectors such as technology, healthcare, consumer goods, utilities, and finance. Some of her chosen stocks include Apple, technology, Johnson & Johnson, healthcare, Procter & Gamble, consumer goods, Duke Energy, utilities, and JP Morgan Chase, finance. Goldie sets her financial sights on JP Morgan Chase, investing an initial $50,000 at a 2.71% annual yield. Alongside this strategic move, she commits to contributing an additional $500 per month to her investment throughout a 25-year span. Goldie's disciplined approach to both her initial investment and consistent monthly contributions yields remarkable results. In 25 years, her financial diligence has paid off handsomely. Her $50,000 initial investment, combined with the regular $500 monthly contributions, grows to an impressive total of $360,982. To maintain her desired diversification and risk exposure, Goldie knows it's important to periodically review her portfolio and rebalances by buying or selling shares of certain stocks. This approach prevents her portfolio from becoming overly concentrated in a single sector. Over the 25-year period, Goldie's diversified dividend portfolio experiences both capital appreciation and growing dividend income. The compounding effect is evident as the reinvested dividends lead to an increase in the number of shares owned. The diversity of her portfolio helps mitigate the impact of any underperforming sectors, ensuring a balanced growth trajectory. This strategy not only reflects the long-term growth potential of dividend-paying stocks, but also underscores the value of diversification. Her annual dividend income has grown substantially, providing her with a reliable stream of passive income. Additionally, the market value of her portfolio has multiplied showcasing the cumulative effect of disciplined investing and the benefits of a diversified approach. And our third recommend for Goldie and yourself is the Dividend ETF approach. This is more of a hands-off approach. Goldie can consider using dividend-focused, exchange-traded funds, or ETFs, to implement the Dividend Snowball strategy. ETFs provide instant diversification and are managed to track dividend-focused indices. To implement this strategy, Goldie needs to choose dividend-focused ETFs that track indices comprised of companies with strong dividend track records. She would then invest in a fixed amount regularly, for example, monthly or annually, in these ETFs to take advantage of dollar-cost averaging. Many dividend ETFs automatically reinvest dividends back into the fund, which leads to increased ownership of the underlying dividend stocks. This approach offers Goldie convenience and benefits from the expertise of ETF managers in selecting and managing dividend stocks. Now let's consider Goldie invest in the Vanguard Dividend Appreciation ETF, or VIG, which follows a dividend ETF approach. The VIG ETF has historically focused on companies with a track record of increasing dividends over time. VIG aims to track the performance of the NASDAQ U.S. Dividend Achievers Select Index, which includes U.S. companies that have consistently raised their dividends for a minimum of 10 consecutive years. Goldie starts with an initial investment of $50,000 in VIG, which has historically delivered an average annual yield of around 2.5%. Additionally, she commits to contributing an extra $500 per month to her investment over a 25-year period. Goldie's strategic investment plan, combined with the power of compounding and a focus on dividend growth yield, leads to impressive results. And after 25 years, her disciplined approach yields substantial rewards. Her initial investment, coupled with the consistent monthly contributions, results in a portfolio value of approximately $630,000. The dividend ETF approach, like the one taken by VIG, emphasizes investing in companies with a history of increasing dividends, which can create a dividend snowball effect over time. As these companies increase their dividends, Goldie's income from her investment grows, allowing her to reinvest more and potentially accelerate the growth of her portfolio. This approach aligns well with long-term planning and the compounding principle, ultimately helping Goldie achieve her financial goals through a well-managed, dividend-focused ETF. In all these strategies, the key is discipline and a long-term perspective. The magic of the dividend snowball lies in its compounding power over time. By consistently reinvesting dividends and staying committed to your chosen approach, you can potentially build a substantial portfolio that generates passive income and helps you achieve your financial goals over the 25-year period. After digesting these proven dividend snowball strategies, you're probably still wondering how to construct your ideal dividend snowball portfolio. Start with Dividend Aristocrats, which are a select group of companies known for their consistent history of increasing dividends to shareholders. To be classified as a Dividend Aristocrat, a company must typically meet the following criteria. Dividend history. The company must be a member of a major stock market index, such as the S&P 500, and it must have increased its dividend payout to shareholders for at least 25 consecutive years. Financial stability. Dividend Aristocrats are generally companies that exhibit financial strength, stability, and the ability to sustain their dividend payments, even during economic downturns. Consistent performance. These companies often have a track record of steady business performance and growth over the long term. Dividend Aristocrats are often considered appealing to income-oriented investors and those seeking to build a portfolio focused on stable income generation. Their consistent dividend growth can provide a reliable stream of income and potentially outpace inflation over time. Investing in Dividend Aristocrats can be done directly by purchasing shares of individual companies that qualify, or investors can choose to invest in exchange-traded funds, or ETFs, that track an index of Dividend Aristocrat stocks. Examples of ETFs that track Dividend Aristocrat indices include the ProShares S&P 500 Dividend Aristocrats ETF, NOBL, and the SPDR S&P Dividend ETF, SDY. So let's assume Goldie invests $50,000 in SDY at the beginning of a 25-year period. SDY typically focuses on dividend growth, which can lead to potential compounding of returns over time. Historically, Dividend Aristocrats tend to be established companies with a history of steady dividend increases. Hypothetically, if SDY maintains an average annual return of around 7%. This is an illustrative number, and the actual return can vary. Your investment would be approximately $181,136. It's important to note that while Dividend Aristocrats have a history of consistent dividend increases, investing always carries risk, and past performance is not a guarantee of future results. And to beef up this dividend investment portfolio, we recommend Goldie picks some dividend-paying ETFs, which are shares of companies that distribute a portion of their profits to shareholders in the form of dividends. These payouts offer investors a steady stream of income, regardless of whether the stock's price is rising or falling. Dividend stocks are particularly appealing to income-oriented investors and those seeking stability in their portfolios. The best dividend-paying ETFs to invest in depend on various factors, including your investment goals, risk tolerance, and market conditions. Look for ETFs with a history of consistent dividend payments and a sustainable dividend yield. Reputable dividend-focused ETFs, such as the VOO, VTI, or VIGI, can provide diversified exposure to dividend-paying stocks. Dividend aristocrats, like those tracked by VOO, are also worth considering as they consist of companies with a track record of increasing dividends over time. It's always crucial to conduct thorough research, consider the company's financial health, and assess the sustainability of its dividends before investing. A well-balanced portfolio might include a mix of dividend aristocrats and growth ETFs aligned with your financial objectives. Consulting with a financial advisor can help tailor your investment strategy to your specific needs and risk tolerance. The thrill of dividend learning doesn't have to stop here. If you're hungry for further expert perspectives on enhancing your wealth and fine-tuning your dividend strategy, be sure to click that subscribe icon and enable notifications. Up next, we expand on the Dividend Snowball and discuss the top 7 compounding assets to start investing in today. Keep learning with us and head to the next video.